Hey everyone, I am here with Nate at Narada Real Estate, and we are so excited to share this one with you. There he is. Look at Nate. He's in Hawaii.
Yeah, I brought up I'm really here, guys, for real. So
Amazing. So Nate and I were talking about what most of our clients are asking, and one of the questions that we always get is, how do I know a good investment is a good investment? Like, how do I read the numbers? It's super confusing. Everybody's always throwing out random terminology, like what is cash on cash return and what are the most important things I should be looking at? And so Nate and I put our heads together and we were like, hey, let's just dive into this pro forma. This particular pro forma was created for me actually by an engineer. And I love it so much because it's super simple, but it also gives us some really cool insight. So, and Nate also has this pro forma, but he also has his. His is awesome as well, but everybody has their preference, what
yeah,
what they want to use. This is just one of the many tools that we have, right, Nate?
that's correct. Yeah, and if anybody does watch this and they want this particular one for me, I will gladly send it to them, and I use it sometimes as well. So
Awesome. Okay, let's dive into it. Now, I picked this property, Nate, because number one, this is a fantastic market in Baltimore. We've got an amazing team there that does beautiful turnkey renovations. Now, people get scared when they hear about Baltimore a little bit. So we want to make sure you're in good neighborhoods. And so that's why this property price point is a little bit more expensive than some of the other properties we have, because we want to make sure that you're in a nice, good area, attracting a good quality renter.
yeah,
Um, and we get some nice appreciation in this area as well, as long as you're in a nice area. What do you think about Baltimore, Nate?
I think Baltimore has some very strong price to rent ratios. Obviously, this property is a little bit more expensive because it's going to be in a nicer area, probably an A type neighborhood. But I think Baltimore has economic anchors that make sense. Fortune 500s. It's got the percent rentage wise. There's a high percentage of renters there. And the key to all this, guys, I think, in my opinion, is property management. Right? You can buy properties in probably any city that you want, but you want to have a good property manager to watch your property. So.
100%. And I've known this team for at least 8 years. And I honestly don't hear any complaints or any issues on the property management side. They're very responsive, very organized. I think organization is a big thing with property managers when they have a system of communicating is pretty a big deal. So, and also one thing to note, since we're talking about property management, if you look at this sheet down here on the lower left-hand corner under assumptions, you're going to see a management fee that says 6%. One of the things that we have done here at Narada for our clients, everybody knows the interest rates changed and they went up a little bit. They're not terribly high, but one of the things that we didn't want our investors to lose their returns. So we went to all of the teams that we work with here at Narada, our trusted partners, and we said, hey, what can we do for our clients to give them a little bit more on their returns? And we negotiated with them for you. So this is one example where you get 6% property management fee for our Narada clients. So that's pretty awesome. So you're going to make a little bit more money now. The other thing that we have negotiated now, each of our teams that we work with, we've negotiated different things, and every property is actually unique. And sometimes we can negotiate a little bit more on the property. One thing that you'll notice, let's actually just kind of start diving into this right now. At the top of the page, it says initial market value, and then it says purchase price. So we have already negotiated this price for you on this house, on this property. So this property should appraise for about $235,000. We got the price down to 205 for you. So super awesome. You get to buy an asset with a little bit of equity in it. So pretty awesome there. Now, when we run these numbers, the first thing on this pro forma that we add in is that purchase price there. Then we're going to keep looking down to income. The rents on this property are $1,800. Okay. I fill in all the stuff for you. Nate fills in all the stuff for you.
Yep.
You don't need to guess. Don't worry about it. We got you. That quote comes from the property managers, by the way. I am not a property manager. I'm not about to guess and just, hey, that looks like a great rent. Let me throw that in. Nope. Nope, that's coming from the property manager.
Correct.
The next thing that we're going to do, we're going to plug in this for you. You're going to see the expenses column. So these are the fixed costs. We know we have to pay these every month. We've got the property taxes, the insurance, and the management fee. Okay. Those are automatically calculated in there for you. Now, one thing that we're going to do, I'm going to skip net performance for now. Let's keep looking down the line and you're going to see mortgage info. This is where you can put in, if you're going to put down 20% or 25%, I always just leave it at 80%. You're putting a 20% down, pretty standard. I'm just going to leave that there. It's automatically going to calculate the math for you. Average interest rate. Right now, we know that we can get you rates around 6.5%. It's an average rate. Yours might be a little bit more, might be a little bit less, you know, depending on so many factors. We're just going to put the 6.5 in there. And then the other assumptions, these are, actually, let's talk about the assumptions later. I'm going to leave that one. Let's talk about how everything else is calculated. Now, when I'm running through this pro forma, all this stuff is done for you. So the main number that you need to look at now, if you look over to the right-hand side of the screen, the bottom lower left-hand corner, you're going to see financial performance. And it's going to say year 1, 2, 3, all the way up to year 10. I wish I had like a little sling thing that I could highlight a little bit better. But what I want you to do is look at the lower left, or well, the right-hand column. On the bottom, you're going to see cash on cash return. And it says 13%. Okay, so many things to dive into about this one. And then I'll get your thoughts on it, Nate. First of all, year 1, 13% cash on cash return is insane. Like, imagine this. You have money sitting in a savings account earning 0.001%. To earn anything like this is very hard to find. Now, if you look straight up that column from year 1 and you go to annual cash flow, monthly cash flow, this property has $517 a month in cash flow. You guys, this is just year 1. Absolutely fantastic. Now let's talk about cash on cash return. What is that and where did that number come from? So the way I calculate it on the spreadsheet, now again, everybody does it different, which is why it's important to always ask people or find out how they calculated that return. What I do on this spreadsheet is if you go back up to the very top where it says first year performance, it says initial cash invested, $47,000. Now this is an estimate because we don't know for sure exactly what your estimated closing costs are going to be. Putting 20% down plus closing costs. By the way, your closing costs are a tax write-off. So just put that little nugget of information in the back of your head.
Yep.
So you put down $47,000 of your own hard-earned money. This is money you took out of your bank account and you're going to put it down on the property. How hard is that money working for you? So if you were going to say, you know, hey, my brother is starting a startup and he wants me to invest in it. Cool. What is that return going to look like for your money? That's why I love using cash on cash return. It's because we want to know about your cash and what it's earning. So now we're going to take that $47,000 and we're going to divide it by that annual cash flow. Now the annual cash flow, I am calculating it after all of your fixed expenses are paid.
Yep.
So this is your profit. So after taxes, insurance, property manager, all of that, mortgage, your profit is divided by what you put down as your down payment. Your cash on cash return is 13%. Your hard-earned money that you took out of your bank account is earning 13%. So anything to add, Nate?
Yeah, I think you hit the nail on the head, right? PITI and property management, right? When you're initially evaluating a property, what is your money doing for you? Right. And from a cash on cash return perspective, a lot of people add in a ton of costs and things like that and variables to get that number. I calculate the same way. I want to know what's the ROI on my down payment and my closing costs after PITI and property management. Those are our 5 major fixed costs that we factor in. So couldn't have said it better. You know, I think it's, as you said, you know, to make a double-digit return, this is a phenomenal property. To make a double-digit ROI on, you know, 47,000 down payment is fantastic. So
perfect.
Yeah.
So guys, we're going to make it even awesomer.
Awesomer.
So awesomer. You guys, this is only year one. Why are we just focusing on year one? Real estate is a long-term investment. This is a wealth creation. This is generational wealth. We are not going to focus on year one, which is why I love this pro forma so much. Now, we want to check year one and make sure, hey, can we make money? Are we going to be in the red? Cool. We're actually making a lot of money here. So let's move on. Don't stress about it. Don't worry about it yet. We're going to come back to the assumptions and what if there's maintenance and what if the vacancy. We're going to come back and cover that. There's processes for that. Don't worry, we're not skipping that on purpose. But let's just talk about this pro forma and how we can create wealth with real estate. So if you look up, okay, so we're going to go back to that column down at the very bottom where it says financial performance. So the cash on cash return is 13% year one. Now, what happens every year? Let's scroll over with your eyes and go to year five. Year five, it says your cash on cash return is now 18%. Well, how could that be? How did my cash on cash return grow? I didn't put any more money down. I didn't, what is happening? Well, this is rental increases. This is why your cash on cash return goes up. Now, one of the columns that I told you I was going to ignore and come back and talk about, let's go back and talk about that. So if you take your eyes and scroll back to the left, you're going to see assumptions, which is that line 50. Now, I plugged in these for you. I try to be very conservative. What we like to do here at Norada is look at historical numbers. Because we've been in business for over 20 years, we have a lot of data, not only our own in-house data, but we're also looking at market trends and information. So we're going to use historical data. We've got an average real estate appreciation rate in this market at about 5%. It might be a little bit more, might be a little bit less, and recently has been a lot more. We're going to use a historical 5%. Now, what a lot of people don't realize, people say, oh, I just want cash flow, cash flow, cash flow. I don't care if a market grows. Well, the reason why you might care if a market grows is because if a market is growing in value, that means you have an opportunity to also raise your rents because the rents keep up with the pace of appreciation. Not the same rate, but the same pace. So if a market is appreciating and there's supply and demand, there's going to be rental supply and demand. So rental income increase is a number I plugged in for you. It's going to be an average in this market, 2 to 4%. I'm just going to use the 3 and just be kind of a little bit in the middle on that. So I plugged in that for you. You can mess around with it. If you want to be really conservative, put 2. If you want to go crazy and have fun, put 6. Honestly, this is a really realistic number that we've seen with our clients, a 3. So since that is plugged in for you, now when we go back over there to that financial performance on the right where it said year 5, that's why we're all of a sudden now you're getting an 18% return because that rental increase potential just raised the value of that property. Now, this is a 30-year loan. So if you didn't touch this loan and you just let it ride, look at year 30. Your cash on cash return is 66%. And I know 30 years sounds crazy and it's super far off. So let's just kind of look at year 5 and year 10. That's where math really gets exciting. What do you think, Nate? Anything to add?
Yeah, a couple things to add there is that, let's remember that's off. This is assuming that you're not going to go out and like pull cash out and do things fancy with your property. But at the end of the day, where else are you going to make 18% year 5 cash on cash, plus your other profit centers, which we haven't even hit on yet? And one thing to revert back to as well, when you said you were keeping it conservative on the appreciation side, right? 3-5%. Let's remember, guys, cash flow is one factor that was, a lot of people were talking about that and it was pushed because there was a real estate crash several years ago and there were really inexpensive properties and they were, renting for a high amount. At this point, things have kind of balanced out. Let's say, for example, let's just go total hypothetical. You purchase this property and it was $200 a month in income, but it was 5% appreciation basis for 15 years, right? And it was consistent 5%. If you take out any appreciation based calculator and run the numbers, right, the amount of growth and the amount of, equity you have in that property after a 15-year position is going to outpace the income you make from it anyway, from a cash on cash perspective, right? So that's why I think even being conservative with the appreciation basis, whether it's 3 or 5%, is fantastic, right? You're still gaining something on your dollar. So
Yep. Perfect. Thanks, Nate. The other thing that I would add on that, just because I had a conversation with a client yesterday about it, and they're like, well, what if the market changes and all of a sudden my value goes down? And I'm like, are you selling?
yep.
They're like, well, no, I'm planning on holding this. I'm like, well, then why do you care? You know what I mean? Like, we know for a fact, proven fact, that real estate always goes up. Always, 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 because we have inflation. So inflation, and also lack of housing and high demand. So you only worry necessarily about that situation if your exit strategy was, hey, I'm just going to be in this property for a couple of years. I'm going to time the markets. I'm hoping I can make a bunch of money when it's up at the top. That's not what we're doing here. That's not turnkey real estate investing. I just want to clarify, this is a long-term strategy for wealth creation. This is not a get rich quick situation. These markets are consistent. They're linear. Baltimore is not this market that is going like this, like New York or California or whatever. This is a consistent, steady, high rental demand market. So a conservative appreciation of 4 to 6% is pretty consistent historically. So anyway, so let's actually dive into that, Nate.
Yep.
So if we look at the column right above that, we're going to see equity accumulation. Now you're going to see year one, and it says equity wealth in bold black. I put that wealth piece in there because we need to look at equity as wealth. When people always ask, like, hey, Melissa, how do you create wealth through real estate? Everybody's throwing out this terminology, generational wealth and all these things. You really create wealth through equity. Like Nate said, the cash on cash is cool. Like it's awesome to get $500 a month in cash. That's not going to create wealth. You are not going to quit your job because you have one property bringing in $500 a month. Okay. Now you need a lot of those properties. Let's get you 5-10 of those properties. That's different. But let's talk about the wealth piece of this. Now, if we scroll our eyes all the way over to year 5, what do we see? $146,000. You just created $146,000 of wealth potentially. Now, this isn't 100% guarantee, but this is a conservative estimate. It might be more. You just created wealth for yourself. Now, the wealth is created through the property value going up. And also, don't forget, this tenant is buying you a free house because they are making that mortgage payment for you every single month. So with that mortgage balance going down, the equity going up, what are you going to do with $146,000 in 5 years? Maybe nothing. Maybe your exit strategy is to sell this property, 1031 exchange into an apartment complex. Maybe you want to retire and you're going to sell and you're going to live on it. Maybe you just roll it and just keep it. There's so many exit options for you. And I think that's the key. It gives you options. And so when you add in, now let's look up. So you've got $146,000 of equity in year 5. If we keep scrolling up, your monthly cash flow by year 5 is now $715. So not only are you still getting that $715, you're getting the equity. So Nate, anything to add?
Yeah, and let's remember, a lot of our clients that come to us say, well, I've got X amount of dollars to start with. Let's say you had $50,000 to start with. And a lot of the question is, well, what can I do with, how can I get my next one? How can I get my next one? Right. Well, in this case, you look at even year 3, let's say that you decided to keep the property, but you have $113,000 in equity and you just cash out refi. Let's say you refinance, pulled your entire down payment out of that property. Now you're at what's called an infinite return, right? Now, any money that you're making is you didn't put any money into that property at this point. You've pulled your entire down payment out, and now you go buy your next property, right? So when you talked about what are the options that we have, right? If you're starting with an income or a budget of $50,000, one property can go a long way, right? In building a portfolio. I mean, if you just rinse and repeat the cash out refi option in, by year 10, you own how many properties? You probably own 6, 7 properties at that point by that one purchase, right? So I think it's a powerful thing to look at.
You know what's even more powerful about what you said, Nate, is the government does not see that money you pulled out as taxable income.
Yeah.
You do not have to pay taxes on that money you just pulled out. Yep. That is tax-free money. Like, come on, people. Yep. Like that alone, like seals the deal. Like pull that money out, put it down on the property. You just got another property for free. You just grew your wealth without paying taxes.
Yep. Bingo.
Love it. Else? I mean, honestly, I'm like, what else? It's going to get better. And I'm like, honestly, like I've been doing this for so long now, and it's still like such a shock to me. It's like a no-brainer that it's like the clients that call me and say, well, this is so good to be true. Why doesn't everybody do it? I'm like, because they don't know. Like, no. That's why we're here, Nate.
That's why it's a niche. It is very niche. Not everybody, what you're taught is stocks, bonds, T-bills, Fidelity, financial advisor, right? No one teaches real estate. That's what we do. So
yeah. And well, and the other thing is patience.
Yeah.
Before I go on to the next step, a lot of people want to get rich quick. They're not willing to. Now, this isn't necessarily hard work, but it is hard work as far as your brain goes. Your brain is doing hard work. Okay. You're physically not, but you've got to have the patience and the mentality and the mindset to be patient with this and understand what these numbers can do for you. And that's what this ultimately, this information we're sharing with you is all about. It's, training your brain to think about this stuff in a different way, so that you can be patient and it will pay off. You just have to, realize that you don't just, you run into one bump in the road and you freak out because you have a vacancy and, oh no, I'm going to sell my property. Those are the investors that lose out.
Yep. Agreed. 100%.
Okay. So Nate, I have the last column that I want to cover. This is actually my favorite column. So this goes into, if you guys did not catch the last episode that we did where we were talking about the 5 profit centers that Nate did, this little area figures it out for you. It does the math. So that's why we wanted to follow up with this one right after that.
Yeah.
So I'm going to take you guys back. If you take your eyes back to the first column, and we're going to look at row 31, which is net performance. This is all calculated for you. You guys don't have to do the math. So we're going to look at the first line is net operating income. Okay. This is the property taxes, the insurance, the management fee. Okay. We've got all that. And then it's going to minus the rents, or add the rents minus those items. Then we're going to take into account the mortgage payment. Mm-hmm. So if you see line 34, it says cash flow, $518 a month. Pretty awesome. Then this is the profit centers of what's actually happening behind the scenes that you don't see every year, every month, every day in your returns. Now, if you look at this thing on line 35, it says principal reduction. Every single month, your tenant is writing that rent check. Your loan is going down by $246 a month. Now, first year appreciation. Now, remember, we just used a conservative 5%. Every single month, that property is going up in value, $979 a month. Okay. Now, what we're going to do is we're going to add in the tax savings. These are potentially, now, what we covered in that last episode is the tax benefits. We've got every year you have the opportunity to write off the value of the property, which is a tax loophole that we love. You can also write off the interest that you're paying for that loan. So once we add in tax benefits, this property, you guys, is actually bringing in almost $2,000 a month, $1,915. That is what you're actually getting a month. So when people say, let's just say this was a cheaper property in Birmingham and the cash flow is $200 a month. And people say, oh, who cares? Big whoopee-doo, you're bringing in $500 a month. Well, no. Like, let's actually look at what you're actually bringing in. This property is almost bringing in $2,000 a month. That's a pretty big deal. Now, what we're going to do is we're going to take that and we're going to see what your total return on investment is. And if you look back on this pro forma and we look on that right-hand side again, row 56, financial performance, 102%. that includes that.
Yeah. Game
I'm,
changer. One of the
yeah.
things that one thing to clarify as well is you made a good point about the tax benefits. That's a realized gain. There's two unrealized gains, right? The equity accrual, the principal reduction, and the appreciation, which is, something you can tap into. And you have stuff that hits your pocket, right? That tax savings hits your pocket. That cash flow hits your pocket, right? And the other two are cherry on top.
Yep.
So
Yep. Yep. I like to say the cash flow is actually the cherry on top when you look
there we
at
go.
that wealth accumulation. And so Nate, let's talk a little bit about how do you run the non-fixed assumptions. This is a topic that
Sure.
a lot of people are talking about. I know that when I first run my pro forma and I send it to my clients, I put a 0 for vacancy and I put a 0 for maintenance. And I always get feedback and people go, why did you leave that off? What are you doing, Melissa? So tell me how you handle this assumption.
Yeah, absolutely. So let's go back to when we first started the conversation. What's our profit, right? What's hitting our pocket every month on this property? Well, it's $517.91. Okay. That's what's going into my bank account or into Melissa's bank account or it's the investor's bank account. Once that money hits your account, you can then choose where to delineate how much to save, where to save for things like vacancy, things like maintenance. Now, what I typically recommend people plug in is 5% vacancy, 5% maintenance. That's usually kind of a national average. And our property management, our partners have their own averages as well, right? So some of our partners only run at 3% vacancy, 3% maintenance. So you can go off what the partner is doing, what the property manager recommends, or you can go off what's comfortable for you, right? So once you plug in that vacancy rate, once you plug in that maintenance, yes, it's going to drop your monthly cash flow, but what's the best way to word this? It doesn't mean you're not getting the full 517, right? If you put
It's funny money. It's not going anywhere.
There you go. It's not going anywhere. Exactly. And what I recommend most new investors do regardless is if you're buying a piece of real estate, automatically have your own escrow account already set aside. Take 3-6 months gross rents collected for that property, have it in your business checking account, have it in your LLC checking account or a savings account just for things like a rainy day, for things like vacancy maintenance. Because just because these are turnkey renovated, you're going to have a ticky-tack plumbing issue your first year. Right? You're going to have a $400 bill that you didn't expect, and that's okay. You're a real estate owner now, right? The first time something comes up, it's not the end of the world, right? Usually it's a write-off, and sometimes real estate breaks like cars break, right? So as far as walking my clients through the variable piece, the vacancy maintenance, one, have your own escrow account set aside so you're not automatically pulling a bunch of rent every month to set aside so it feels like you're not making any money. And two, run your pro formas first and foremost from what I call a fixed cost perspective, then your variable cost perspective. Hopefully that makes sense.
No, that's perfect. And what I would add to that is, we know at some point you're gonna have a vacancy. We know at some point you're gonna have maintenance costs. We don't know when that is going to be. Hopefully it's not year 1 because you're under warranty. It could be year 4, it could be year 5. So what we do want to prepare, like you said, for that rainy day. And so what I always tell people do, the assumptions don't really, at the end of the day, they don't matter. And I say that because this pro forma is getting thrown away after you close. At the closing table, you're never going to look at this again because you're not going to look at it and you're going to go, let's say the property manager contacts you and says, hey, Melissa, there was a plumbing issue. Your bill is $150. It's not like you're going to pull up the pro forma and go, but wait a minute, I can't pay that plumbing bill. I didn't account for it in my assumptions. That's not real life. Like a pro forma is just to get an estimated idea of potentially what this property is going to do. Nobody is making any promises or guarantees because you can't in real estate. And if somebody is, they're lying, don't trust them, run as far as you can go.
Yeah.
What you can do though is have fun on the assumptions. You can put vacancy 2%, you can put 20%, you can put 5%. I don't care what you put. That doesn't mean that's actual real. That doesn't mean that's actually what's going to happen. It's just a place for you to run worst case scenarios. honestly. So if you are a person that literally can't sleep at night because you want to make sure that you're going to have all this extra money to put aside for vacancy, then you know what? You should be putting your monthly cash flow every month into a bank account. Don't touch it. Don't spend it. Your monthly cash flow is going to be plenty of money over the years to cover those expenses. So you can actually look at your cash flow, the entire amount, as your slush fund, emergency fund. It depends on how you want to do your banking, how you want to set up your banking, and how conservative and risk tolerant you are. One of the things that I would love to add too, though, is some of our property management companies, we have negotiated free property management for a year. So that is the perfect time.
Yeah.
If you're going to put any extra money aside in a savings account, do that the first year while you're getting that free property management, because your cash flow is going to be pretty darn awesome. Put, whatever it is, 6 months, what you said, 3 months for, it doesn't matter. Put whatever money you want aside in a savings account. That's your slush fund for the property. Now, every time you buy a new property, your slush fund will grow. And then you can decide what you're going to do with that slush fund. Is it's too big? You're probably not going to need that much for, to cover expenses. Your properties start supporting each other as a portfolio. So if you've got 5 houses, 10 houses, the chances of them all having a vacancy or maintenance problem at the same time is pretty slim. So the properties support each other, and they help pay for each other. So that's the thing that I always tell my clients as well is, my happiest investors are investors that own many or multiple properties. You sure don't worry about them individually, and you kind of look at them as a portfolio return.
Absolutely. You couldn't have said it better. I love how you mentioned there's power in numbers, right? Most investors have a goal of owning multiple doors. And so once you have 5, 6, 7, 8 properties and you have 2 vacancies at one time, okay, well, if you have cash flow from the other 6, swing it over and support yourself with, those maintenance bills for that month, right? Yep. So
done.
Good
Easy.
stuff. Good stuff.
A lot of good stuff. So I think I'm done with everything on this pro forma. There's a lot of other numbers on here. I mean, you don't really need to worry about them. I mean, have fun if you're, an engineer type person and you want to dive into stuff. Down at the bottom, you're going to see tabs where you can see some other items like how the loan is broken out, the loan amortization schedule. I'm not going to go over this one. Message me, message Nate if you've got questions how to do that one. Basically, it gives you a tool where you can run scenarios if you wanted to pay off the property sooner, which is that real estate snowball effect. So if you're closer to retirement and your goal is like, hey, I want to put all that cash flow back into the mortgage every month, that loan amortization schedule can help you do it. So reach out to me and Nate about that one. Reach out to us about any other questions you have about this pro forma. Reach out to us if you're interested in this property. I don't know if it's still available by the time I put this out there to you guys, but it doesn't matter. We have plenty of other amazing inventory in Baltimore and Ohio and Little Rock and Indianapolis and so on. We can go over the strategies with you. We can go over your goals. We can go over what's more important to you. Some of our markets have more appreciation and some of our markets have more cash flow. Some of them are more hybrid like Baltimore. That's what we're here for. That's what we do every day. So yeah, just message us. Hopefully you've got Nate's information, Nate at naradarealestate.com. Mine is Melissa at naradarealestate.com. Hit us up. Anything else to add, Nate?
No, I think we're good to go. And great job, Melissa. I appreciate you walking us through us. I learned stuff today as well. And until next time, we'll keep doing these.
Awesome. Have fun in Hawaii, Nate.
Oh, always. Be well.
Okay, bye.
Bye.